This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, fellow investors. Welcome to episode 28 of Value Investing. In this episode, I'm going to continue to talk about Warren Buffett's views on various topics. And I want to cover three topics on today's show. First topic is Warren Buffett's views on global diversification strategies for portfolio management. And second, Warren Buffett is talking about how he considers macroeconomic factors when it comes to investing his money. And finally, we're going to go over the topic related to buying the entire business versus buying a portion of business in terms of pros and cons. I'm so excited to cover all these topics. But before I do, I just want to give you a quick disclaimer that this podcast is for entertainment purpose only, and it is your responsibility to consult with your investment professional for any investment decisions. And as I mentioned before, 5-star review always goes a long way, whichever platform you listen to this podcast. So once you get a chance, please rate this podcast, and that's going to make this podcast available for other value investors who may not really know the existence of this podcast. So without further ado, why don't we get started? Okay, the first question is about whether Warren Buffett has any global diversification strategy for his investment portfolio.
The question is about global diversification. All we want to be in is businesses that we understand, run by people that we like, and priced attractively compared to the future prospects. So there is no specific desire to either be in the rest Europe or the rest of the world or Far East, or to avoid it. It's simply a factor that it's not a big factor. There may be more chances for growth in some countries. 80% of Coca-Cola's earnings, roughly, will come from outside the United States. 80% of Guinness's earnings will come from outside the United States, but they're domiciled outside the United States, whereas Coca-Cola is domiciled here. Certainly, in many cases, there are markets outside the United States that have way better prospects for growth than the U.S. market would have, but they probably have some other risks to them that this market may not have. But we like the international prospects, obviously, of a company like Coke. We like the international prospects of a company like Gillette. Gillette earns 70% of its money outside this country. So if you look on a look-through basis, Coke, we might this year get something like $150 million of earnings indirectly for Berkshire's interest from the rest of the world just through Coca-Cola alone. But we don't make any specific, we don't think in terms of, I like this region so I want to be there or something of the sort. It's something that's specific to the companies we were looking at, and then we'll try to evaluate that. Coke is expanding in China. Well, I think I forget what they showed last year, maybe 38% growth or something like that in cases. It's nice to have markets like that are relatively untapped. Actually, Gillette is expanding in China in a big way, and the Chinese don't shave as often, and more of them are what they call dry shavers than wet shavers there, which is electric shavers. But maybe we could stick something into Coke that would come. Maybe a little synergy at Berkshire finally. Who knows?
Okay, I think Warren Buffett brought up very interesting points here related to global diversification strategy. Because if you're a retail investor and if you have your own financial advisor, then he or she would likely give you advice to diversify your portfolio across different regions, not just in the US, but international markets and across different industries and across different companies. I think that's probably a good way to diversify away idiosyncratic risks that may exist in the market. But if you follow Buffett style, investment style, then you know that Buffett only invests in companies that he understands. I don't think that one style is better than the other. It all depends on which investment style fits your needs. But if you're a Warren Buffett follower, then you're probably gonna have a huge US exposure in your portfolio. But as Warren Buffett mentioned, even though Warren Buffett has invested his significant money in US companies, these US companies became very international in terms of getting their revenue streams from different places. He mentioned Coca-Cola, Gillette, making tons of money in international markets, and that way you have indirect exposure in international market. I think that's another good point. But if you're a Buffett follower and if you really want to focus on his investment style, then instead of worrying about diversification, you rather spend your time on finding companies that you understand that can provide some potential capital appreciation and dividends in the future, rather than worrying about where you need to put your money in international markets. One other thing that I want to mention is that if you're from different country, not in the United States, and if you are familiar with that market and companies in that market, I think you should feel free to invest your money in those companies outside of the United States. The reason why Buffett didn't invest his money in foreign countries is not because he doesn't believe that those markets will not thrive in the future, but rather he just didn't know enough details about those companies residing outside of the United States. Okay, let's move on to the next question. The next question is, what is your view on the current market and the economy?
You may have trouble believing this, but Charlie and I never have an opinion about the market because it wouldn't be any good and it might interfere with the opinions we have that are good. If we're right about a business, if we think a business is attractive, it would be very foolish for us to not take action on that because we thought something about what the market was going to do or anything of that sort, because we just don't know. And to give up something that you do know and that is profitable for something that you don't know and won't know because of that, it doesn't make any sense to us, and it doesn't really make any difference to us. I mean, I bought my first stock, I think, in probably April of 1942 when I was 11. And since then, I mean, actually World War II didn't look so good at that time. I mean, the prospects, they really didn't. I mean, we were not doing well in the Pacific, and I'm not sure I calculated that into my purchase of my 3 shares. But I mean, just think of all the things that have happened since then, atomic weapons and major wars and presidents resigning and all kinds of things, massive inflation at certain times. To give up what you're doing well because of guesses about what's going to happen in some macro way just doesn't make any sense to us. The best thing that can happen from Berkshire's standpoint, we don't wish this on anybody, but over time, is to have markets that go down a tremendous amount. I mean, we are going to be buyers of things over time. Now, if you're going to be buyers of groceries over time, you like grocery prices to go down. If you're going to be buying cars over time, you like car prices to go down. We buy businesses. We buy pieces of businesses, stocks. And we're going to be much better off if we can buy those things at an attractive price than if we can't. So we don't have any fear at all. I mean, what we fear is an irrational bull market that's sustained for some long period of time. You as shareholders of Berkshire, unless you own your shares on borrowed money or are going to sell them in a very short period of time, are better off if stocks get cheaper, because it means that we can be doing more intelligent things on your behalf than would be the case otherwise. But we have no idea and we wouldn't care what anybody thought about it. I mean, most of all ourselves. I mean, Charlie, do you have any?
No, I think if you're agnostic about those macro factors and therefore devote all your time to thinking about the individual businesses and the individual opportunities, it's a way more efficient way to behave, at least with our particular talents and lacks thereof.
If you're right about the businesses, you'll end up doing fine. We don't know, and we don't think about when something will happen. We think about what will happen. It's not so difficult to figure out what will happen. It's impossible in our view to figure out when it will happen. So we focus on what will happen. This company in 1890 or thereabouts, the whole company sold for $2,000. It's got a market value now of about 50-odd billion. You know. Somebody could have said to the fellow who was buying this in 1890, you know, you're going to have a couple of great world wars, and you know, you'll have the panic of 1907. All these things will happen. And wouldn't it be a better idea to wait? You know? We can't afford that mistake, basically. Yeah.
Okay, so there are 2 points that I want to bring up here. The first point is about what's knowable and what's not knowable. Warren Buffett is basically saying that macroeconomic prediction is something that he cannot do. And he's basically saying that this is not knowable. Even though it's important, if it's not knowable, then he'd rather spend his time on something else that is knowable. He's saying that if he makes investment in individual companies, and he may have some better chance to be successful in the future, regardless of macroeconomic factors, how they will play out in the short term. If you focus on individual stocks, individual companies, and if you know their competitive advantage, how they're going to operate within their industry compared to their competitors, and those are the things that could be knowable in certain circumstances, and you should really invest your money without thinking about how overall market is going to behave in the short term or even in the long term. So that's the one point that I wanted to bring up, knowable versus not knowable. Even though you see a lot of macro hedge fund managers focusing on macro economy, that's not the style of Warren Buffett and Charlie Munger. And some managers might be successful in terms of predicting the trend of the market, and I think that's their expertise and their territory. But if you ask Warren Buffett and Charlie Munger, they're saying that this is a waste of time because there are so many factors that can drive the economy in many different directions, and there's no way that anyone can predict the trends of the market correctly in a consistent manner over time. So he rather focus his energy on the things that are easily understood and knowable by doing some research. The second point that I want to bring up here is that Warren Buffett mentioned that if he invests his money, then he knows what will happen, but he doesn't know when that thing will happen. So what that means is when you invest your money in an individual company after doing some research, you find really great competitive advantage that this company has compared to its competitors. You know that this company is going to really do well in the long term, but you don't know when that will happen. So if you're a Buffett-style value investor, and any value investor in that regard, have to be very patient. You know, market is not going to go always in favor of your investment decisions. It can go against you for a very long period of time. But eventually, the market will recognize the intrinsic value of the company that you assessed, assuming that you assessed correctly. Then you just have to be patient. You have to be willing to wait 3 to 5 years until that time comes. It just takes time. That's just a part of the game. You just have to be patient. And as I mentioned in different episodes, that the market is going to throw at you multiple things and negative articles and so on and so forth. If you don't have conviction related to your analysis, it's likely that you're going to sell your stocks along the way before that time comes. So those are the 2 points that I wanted to bring up related to this question regarding macroeconomy. Okay, let's move on to the next question. The next question is about private company investment versus public investment. Warren Buffett has the opportunity to buy entire business at negotiated price versus other investors, retail investors, only having opportunities in the stock market. So the question is whether he sees better opportunities in private investment space.
We very seldom find something to buy on a negotiated basis for an entire business. We have certain size requirements, big limiting factors. It has to be something we can understand. I mean, that eliminates 95% of the businesses, and we don't pay any attention to them, but we get lots of proposals for things that are just totally outside the boundaries of what we've already said we're interested in. We prefer to buy entire businesses or 80% or greater interest in businesses, partly for the tax reasons you mentioned, and frankly, we like it better. It's the kind of business we would like to build if we had our absolute druthers on it. Counter to that is we can usually get more for our money in wonderful businesses in terms of buying little pieces of them in the market, because the market is far more inefficient in pricing businesses than is the negotiated market. You're not going to buy any bargains, and I mean you shouldn't even approach the idea of buying a bargain in a negotiated purchase. You want to buy it from people who are going to run it for you. They want to buy it from people who are intelligent enough to price their business properly, and they are. I mean, that's the way things are. The market does not do that. The market, in the stock market, you get a chance to buy businesses at foolish prices, and that is why we end up with a lot of money in marketable securities. If we absolutely had our choice, we would own we would own 3 times the number of businesses we own outright. We're unlikely to get that opportunity over time, but periodically we'll get the chance to find something that fits our tests, and in between we will, when the market offers us the right prices, we will buy more, either businesses we already own pieces of, or we'll buy 1 or 2 new ones. Something's usually going on. There are tax advantages to owning all of them, but that's more than offset by the fact that you'll never get a chance to buy you'll never get a chance to buy the whole Coca-Cola company or the whole Gillette company. The businesses like that, the sensational businesses, are just not available. Sometimes you get a chance to make a sensible purchase in the market of such businesses. Charlie?
Well, I think that's exactly right. And if you stop to think about it, if 100% of a business is for sale, you've got the average corporate buyer is being run by people who have the mindset of people buying with somebody else's money, and we have the mindset of people buying with our own money. And there's also a class of buyers for 100% of businesses who are basically able and shrewd financial promoters. I'm talking about the leveraged buyout funds and so on. And those people tend to have the upside but not the downside in the private arrangements they've made with their investors. And naturally, they tend to be somewhat optimistic. And so we have formidable competition when we try and buy 100% of businesses.
Okay, so the question was, which one is better between buying the entire business at negotiated price versus buying a portion of business in the stock market? What Warren Buffett is saying is that even though there's some tax advantage related to buying the entire business, he thinks that there's huge price advantage if you buy stocks in the market, which is a portion of business in the market. Because sometimes Mr. Market provides ridiculous price, which is significantly below intrinsic value. So if you're a retail investor and if you know what you're doing, then you probably have huge competitive advantage over other institutional investors like private equity managers. Also, one thing that I want to point out here is that Charlie Munger said that they have to compete with leveraged buyout funds, which are now called private equity funds. And private equity managers tend to focus on upside rather than downside because they are using other people's money and they don't share downside, they always share upside. So they tend to be more optimistic about the future of whatever company they are trying to acquire. So as a result, Warren Buffett and Charlie Munger sometimes have to pay higher price in order to secure the deal. So one thing that I think we can drive home here is that retail investors just like you and me may have really good advantage over these institutional investors in many aspects. The one thing is that we can always go into the market and buy a portion of excellent companies at very, very cheap price. And if you know what you're doing, if you know how to control your emotions, if you are the type of person who are very disciplined in terms of implementing value investing strategies, and if you don't get influenced by Mr. Market, then your investment returns could be a lot higher than the money managed by these professional money managers. So I thought that it's an important point to bring it up. And I thought that this one was a great question. Okay, that's it for today's show. We talked about 3 things today. First, we talked about Warren Buffett's views on global diversification strategy. And second, we talked about how Warren Buffett thinks of macroeconomic factors when it comes to his investment decisions. And finally, we talked about which one is better between buying the entire business or a small portion of business in the stock market. I think these are all great discussions to have as a value investor, and I hope that you enjoyed this episode and learned something from it. One last thing that I want to mention here is that 5-star review always goes a long way, whichever platform you listen to this podcast. So please rate this podcast on your platform, and I really appreciate it. And thank you very much, and see you next time.